Okay, welcome everyone. Happy to have you here today. So we are talking about insurance today. So let me share my screen. First of all, hold on just a second. Here we go. All right. So like I said, we are going to talk about insurance for our review today. So with that, let's go ahead and just jump right in. Okay, so risk management and insurance. So yeah, not just insurance, but we're also going to be talking about the whole risk management side of things. So here are our three major topics for today. So we've got risk management, we've got health insurance, and then we've got home, auto, and other insurance. So we'll be covering terminology. We'll be talking about lots of different vocabulary words. There's a lot of vocabulary that goes along with insurance and risk and different things like that that you need to understand. Health insurance is a big section that we need to make sure that we get into. So we'll talk about different types of health insurance coverage that are out there, various medical accounts that are out there. And then we'll talk, like I said, about home, auto. We'll get into renter's insurance, disability insurance, long-term care. Life insurance is also one that we'll be covering today. So those are kind of the overarching topics that we'll be covering during this webinar today. So with that, let's get into a true or false question. So we'll go ahead and bring up your chat if you don't have that up already. So in insurance, a hazard and a peril are the same thing. So is that true or is that false? Jesse says false. Who else? Got lots of false coming in. Good job. Yes, you are correct. That is a false statement. So a hazard and a peril are two very different things, which we'll be looking at here on the next few slides. So yeah, we'll go ahead and get into the vocabulary now. So we've got exposure, we've got hazard, and we've got peril that we need to make sure that we understand. So we'll go through the vocabulary words, and then we'll go through a page of examples so you can say, okay, what's an exposure, what's a hazard, and what is a peril. So not apparel like what you wear, but a peril, P-E-R-I-L. So, okay, exposure. So exposure is the source of risk. And like I said, this will make a lot more sense, hopefully, once we get to the slide about what each of these are. But exposure, that's what you're looking at. So there's a source of risk in basically everything we do. A peril is an event that can cause a financial loss. So it's a specific event. It's not just the bike that happens to be on the sidewalk or the skateboard on the sidewalk or the ice on the driveway or whatever. It's an event that actually can cause a financial loss. And then finally, hazard is a condition that increases the possibility of that peril occurring. So again, it's a condition that increases the possibility of that peril occurring. Now, I know when I studied this the first time, it was kind of hard to understand the differences there. So hopefully this next slide will walk you, well, after we do some examples here, we'll do some examples on the next page. So actually, let's come back to this question after we do this. Okay, so we've got 4 examples. We've got auto, home, health, and life. So the exposure for auto is driving a car, right? That's and let's go back to the definitions. So exposure is the source of risk. Okay, so remember we've got the source of the risk is the exposure, the peril is the event, and then the hazard is the condition that increases the possibility. So again, we've got in the auto, we've got the exposure. The source of risk is just driving a car, right? We've simply got an exposure just because we're driving a car. So the peril is the actual event. So that would be something like a car accident. And then the hazard would be driving while intoxicated. So that's the condition that increases the chance of a peril occurring. Right? If we've got ice on the road, we've got black ice, then that's a hazard that could cause a car accident. So that would be another example of a hazard. Rain would be another hazard where you could hydroplane, different things like that could again cause a car accident. Looking at a home, so exposure, that again is the source of the risk, and that simply owning a home is the exposure here. So a hazard could be old wiring. It could be a number of other things in the house as well, but old wiring could be one of them. And then the peril or the event that actually happened is the house burning down. Let's go to health now. So the exposure, living, right? That's a source of risk for everybody. Hazard, so the condition that could cause the peril could be high blood pressure, and heart attack would be the actual peril. So that's the event, again, that happens. If we look at life, again, the exposure is living. The hazard could be wartime. It could be a lot of other different things. And then the event or the peril would be death. So again, I want to just review these one last time to make sure everybody has got this. So the exposure is the source of risk, right? That's driving the car, owning the home, or living in these four examples here. The hazard is the condition that could cause the peril. So driving while intoxicated, old wiring, high blood pressure, wartime. And then the peril is the actual event. So it's the accident, the house burning down, the heart attack, the death. That's the thing that actually causes the financial loss is that peril. So before we move on, I want to see, I'm going to pull up the chat. Does anybody have questions about this? So yeah, Summer says it's a lot of vocabulary, but these are terms that insurance company use. So it is important to know them. Absolutely. It is important to understand these. So does anyone have a question about these three terms specifically? It's always been so confusing. Absolutely. Yep. These three can be confusing. So running through lots of examples that'll walk through, what's the exposure, what's the hazard, what's the peril is helpful. Anyone else questions about these? I'm going to give you just a moment in case you're typing. All right, well, we'll keep an eye on the chat just in case anything additional comes up in there. All right, financial trivia. What are your options when you're faced? Okay, I see a chat. Okay, yes. So make sure your chat is set for everyone. Just make sure everyone, if you're typing in here, make sure you're not just typing to Summer or myself. Make sure it's set to everyone. Okay, so you've got a client or you are faced with risk. Everyone is every day, right? We have these exposures. We've got these hazards. So what are some options when you're faced with risk? What are some steps that you take? What are some things that you consider? Yeah, transferring that risk. Thank you. Others? And that's the big one, right? Yep, mitigate. Thank you. Get insurance. Yep, that's transfer. Avoid it. Absolutely. Yep, we can avoid risk in some cases. Avoiding, retaining. Thank you. Explore other options. Okay. Yep. Maybe instead of driving, you take the bus. Maybe you walk. Maybe you ride your bike, which, have their own exposures and hazards as well. But it could be other options that we could consider for sure. Okay. Controlling loss. Thank you. All right. Good job. Thank you, everyone, for participating in that. So here are our 5 options. We've got risk avoidance, risk retention, risk transfer, risk reduction, and loss control. So these are the 5 different things that we can do. I think most of those were hit in the chat. So again, and we'll go through each of these individually, but we can avoid risk, we can choose to retain it, we can transfer it, we can reduce risk, or we can do loss control. So we'll go through each of these now. What are the most important factors to consider when managing risk? I'll just pull it up here. So frequency and severity. Those are the 2 biggest factors that we need to consider. And then I think after this, we'll get into managing risk. But yeah, frequency. So how often does it happen? And how financially damaging is it going to be? So what's the severity of it? And that's what we have to consider when we're looking at these 5 factors here. Are we going to avoid it, retain it, transfer it, reduce it, or deal with some loss control? So those are the factors that we have to consider when we're looking at these. So let's start with risk avoidance. So the example would be to not drive, right? You could choose, there may be other options. Like I said, you could take the bus, you could take the bike, maybe you get a job where you work from home, but you can avoid the risk that comes along with owning a car and getting in a car accident and the various hazards that are introduced because of driving. So you can avoid that exposure entirely. You can just choose not to drive a car. And I know people that have done that. I've got a nephew who he doesn't drive. He takes public transportation. He uses Uber and different things, which again, there's risk in everything. So it's not like he is eliminating that risk entirely, but he is avoiding the potential exposures that come with himself actually driving that car. Okay, so risk reduction would be the next one. And this is where you are driving defensively. So you're very aware of your surroundings, you're aware of other drivers, you're making sure that there's a proper distance between you and the person in front of you. You're taking all of these steps to help reduce that risk. You're slowing down when it's snowing, right? Or it's raining, or maybe you're taking different roads, the ones that have been plowed. So we had a big snowstorm here yesterday, and my girls have an early morning class, and they got about a couple blocks away, and they realized that none of the roads had been plowed yet, and they turned around and came home. So they reduced their risk that day because they chose not to drive. Okay, I see a couple of chats coming in here. Seatbelts, yeah, that's driving class is definitely something you could do to help prevent that. Seatbelts, decide if I can handle a bad outcome, like choosing a deductible. Absolutely. Okay, so risk transfer. This is the big one, right? And this is what we often associate with risk we transfer that risk to an insurance company. We've still got the exposure, we've still got the hazard, we've still got the peril, but the actual frequency, if we know that there's a high chance of loss, which there would be in a car accident typically, then it might be a good idea to transfer that risk over to somebody else. So that's why one of the reasons we buy car insurance. A risk retention, so this would be an insurance deductible is an example. So a small loss, you're going to cover that through the deductible. And we'll talk more about deductibles in a couple of different sections today. Loss control, so this is where you're trying to reduce the severity or the frequency of the loss. So the examples here would be to drive a less expensive car, install a car alarm if you do have a more expensive car. So there's lots of different options that you can choose to help reduce either the frequency or the severity or a combination of the two. Okay, moving on. So vocabulary, lots of different vocabulary, like I mentioned in this section. So premium is the first vocabulary word that we're going to look at. So the premium is simply the cost of insurance. And that's true across, these words are true across all different insurance types. So our health insurance, we've got a premium for it. Our auto insurance, our life insurance, everything like that, any type of insurance, there's always a premium included with it. And that's simply the cost of the insurance. So what's the deductible? So the deductible is the amount that you pay out of pocket before the insurance kicks any in. So for example, if I'm in an accident and I cause $1,000 worth of damage, I might have a deductible of $500. So the first $500 comes out of my pocket, and then after that, it comes out of the insurance company. And that would be true whether it's $1,000 loss or a $10,000 loss, whatever the case is. My portion is that initial deductible. And that's something that as financial counselors, it's important to make sure that people understand that and they know where that deductible would come from. One of the things that my wife and I have done is that we've created a deductible category in our budget, and we've made sure that there's enough in there to cover any sort of auto deductible or any other deductible that we need would be covered out of that deductible fund. So just something to consider as you're working with your clients. The emergency fund can also help function as that, but we just like to have a separate line in our budget that is just for those deductibles. And I'm seeing a chat come through here. Oh, Summer says she likes that. Yep, it works very well for us. All right, so here's a real world finance question. So pull up your chat. So which is better, high deductibles or low deductibles? What do you think? Yes, depends on the case. Exactly. Yes, I'm so happy you're all putting depends on in here. So yeah, the ability to pay, all that kind of stuff comes into factor here. So yep, definitely depends. So there is no right answer, obviously, to this. So it always depends on the situation, the person, their how comfortable they are with risk and the exposure and all these different things. All right, so let's move then into determining what the premium is and all these different things. So the large loss principle. So what this principle says is that we should insure risks we cannot afford and retain the risks that we can afford. So I remember in my very first personal finance class, we talked about this, and she talked about how if your home burns down, you probably aren't going to just have the cash sitting around that you can rebuild it. So that's why we get homeowners insurance. It may also be required by the mortgage company. Well, it's going to be same with a car. but you don't want to, there's a high severity, or the severity is big there. So you don't want to just not, you can't just retain that risk. But then she talked about, well, you could insure, hypothetically, you could insure your dishes, right? Your plates and your cups and different things like that. But the frequency is so high of those breaking, but the severity is really low. So you break a cup or something like that. Yeah, it's a pain to clean up, and you know, it's one of those things that you don't really want to have to deal with, but the severity isn't that bad, right? You can go out and you can buy another cup. It's not that big of a deal. So you retain that risk because there's no reason to transfer that over to someone else. All right, trivia question for you. What is the most expensive type of insurance? So what is the most expensive type of insurance? What do you think? Give you a moment to put that in the chat. It depends, but health, yep, yep. None when you need it. Yeah, there you go. Health, the type you don't have. Oh, I like that, Kimberly. Yes, that's very true. The type you don't have. Health, comprehensive health, could be car, when you can't afford. Okay, excellent. So yeah, it's, as far as premiums go across the board, health insurance is the most expensive one. So when we're just comparing premiums, then health insurance is the one. So looking at, so we'll jump into health insurance now. So there's more vocabulary here. Again, I know that there's a lot of vocabulary with this unit specifically, but it is important to understand these terms because they go across the board, and it's important that you understand them. So first one is copayment. So copayment in health insurance, this is a payment that is required at each transaction before any insurance coverage begins. So a typical example would be you go to the doctor's office and you might have a copayment of $25, or maybe it's $100. Or you go to the emergency room, maybe you've got a copayment of $250. So that's the amount that you have to pay, and it's required at each transaction. So every time you go to the doctor, you might have that $25 copayment or whatever that amount might be. And that's before any insurance is going to kick in. Okay, coinsurance. This is a type of insurance where a percentage is paid by the insured. So coinsurance, you might have, let's just say on your health insurance, you pay your copayment, right? You go in to see the doctor, and then you pay 20% and the insurance company pays 80%. So your percentage is that 20% that you're paying, while the insurance company is going to pick up the other 80% until you hit the out-of-pocket maximum. So you can see how all these work together. So you pay that copayment, you then pay your percentage, and up to whatever your out-of-pocket maximum is. So this is the maximum amount, or the most that the insured person will have to pay each year. So you might have an out-of-pocket maximum of, say, $2,000, and you're paying your 20% every time you're utilizing this insurance until you hit that $2,000. And then after that, the insurance company covers everything. So your out-of-pocket maximum, again, is the most that you are going to pay for the year total. Additional vocabulary words. So qualified medical expenses. So these are expenses as defined by the IRS that can be paid through a tax sheltered account. And we'll be looking at the two tax sheltered accounts here in just a moment, but the IRS defines certain medical expenses as eligible to be paid out of these tax sheltered accounts. And again, these are called qualified medical expenses. And that'll bring us to our trivia question. So there are two tax sheltered accounts for medical expenses. Can anyone name one or both of those? So go ahead and put that in the chat. Yes, like an FSA, FHA, FSA, HSA, exactly. Yep, those are the two different kinds. So we'll look at each of those here. All right, yep, so they are the health savings account, or HSA, again, health savings account, or flexible spending account, or FSA. And there are differences between the two, so we're going to take a look at each of these so you understand what the differences are between them. So here we go, health savings accounts. These are awesome. I love health savings accounts because of how flexible they are. So basically, you put money into a health savings account. You have to have a high deductible health plan, or an HDHP, in order to utilize one of these. So if you've got a high deductible health plan through work or through insurance that you're buying yourself, you can get a health savings account. And so what happens with these is you just typically you put money in every month. So my health savings account, for example, I put money in every paycheck, and so does my employer. So money's just getting deposited into that account, and it just accrues over time. So if we've got no medical expenses, it's going to build up over time. It can only be used for healthcare. So it can't be used for, you can't go to Walmart and use your health savings account to buy food or anything like that. But the nice thing about health savings accounts is that the money carries forward indefinitely, so that you don't have to use it by the end of the year. It carries forward indefinitely. So what is considered a high deductible plan? So they're actually called a high deductible health plan. So they're actually titled that way when you're looking at them. I know for my insurance, we can either choose the high deductible plan or we can choose a different one. I don't know the numbers off the top of my head. There are a couple of other minor considerations for HSAs. That is correct. So I don't know what the numbers.
Jump in really quickly. I'm pretty sure it's $1,550 today now as your deductible, but it does change every year, so you want to check. There's also a maximum that you're allowed to have for the mandatory deductible, which I want to say is around $6,900. So anyway, usually HSAs are identified as HSA compatible plans in the plan listing.
Exactly.
Sorry.
Yep. And there's also a family amount that you can put in. So you've got an individual amount, and then you've got a family amount. So you can put more into your HSA if you've got a family. So Sonia says, if you have an illness, you should choose HSA. True. So you can't really choose. So you've either got an HSA or an FSA. You don't have both. And so if you've got a high deductible plan, then certainly you would want to use the funds. I mean, that's the purpose of these funds in an HSA, is that you can utilize them for that illness. Now, one nice thing about the HSAs is that you can just save it up, right? So if you're young and healthy and you're depositing money in there, it can just accrue, and then you get to retirement when maybe you've got some more medical expenses and you've got this large HSA built up. So it can help pay for medical costs once you get to retirement as well. And you can invest these funds if you start to build up a lot in there. It's something I would be very cautious about. But it is a possibility. Okay, a couple of things have popped in. You can also use FSA if you have an illness. You just have to use it up. Yeah, we'll talk here about that in just a minute. Do employers always contribute? No, they don't have to. A lot of them choose to contribute, but they certainly don't have to contribute. It's not a requirement or anything. You can also use HSA funds in retirement for non-medical costs, though. Exactly. So if you choose it, let's just say you've done really well in your health savings account, you've saved up in there, and you've got $1 million at retirement. You can use it for non-medical costs, but you will have to pay taxes on it. Because when you pull, you get it, first of all, you get a tax deduction for putting money into an HSA, and then it's tax-free if used for medical expenses. So lots of great tax benefits tied into it. Can be used for other expenses. Yeah. So in retirement. So I think that's after summer, you could jump in here. Is it 59.5 still, or did they change that to 60? I can't remember. So Summer, if you get that.
Sorry, I was typing and I realized that's silly. I'm pretty sure it's actually 65 for that particular component, but you can always research that. And I encourage you to do that. It's good practice for research in general.
Yep. So is an HSA pre-tax like an FSA? Yes, it is. So you get a tax deduction for any money that you put into an HSA. So very good question. All right, so let's deal with a flexible spending account next. So an FSA, these are not as popular as they used to be because of the limitations. So the idea is that whatever amount that you choose to put in there, you put in at the beginning of the year, and your employer may contribute some, you may be putting some in there. But the idea behind this is you have to use it by the end of the year, or it's gone, right? It just gets absorbed back in your employer, it just gets that back. So if you put, say, $7,000 in an FSA and you only use 6,000 of it, then it goes back to the employer, that additional 1,000. So I always see articles at the end of the year, like, here's how to use some additional FSA funds if you've still got some left in there. So that's why health savings accounts are so popular, because, they can just accrue indefinitely. They've made it easier in recent years by being able to buy over-the-counter medicines, bandages, etc. Yeah, I've seen that, where people will go out and buy like just tons of things like, over-the-counter medications and Band-Aids at the end of the year. They pre-purchase them for the next year or so, for the next couple of years or something like that. So it can be used for medical or childcare expenses. That is one of the benefits of an FSA. You do have to have an employer in order to use this. So you can't set up your own FSA account. You can't just say, okay, I'm self-employed and I'm going to, I guess you could set up a health insurance plan through self-employment, but basically you have to have an employer to be able to do this. Okay, Summers put some additional information in here. So 65 is the age you can use HSA funds for non-medical expenses. So after that, you're still going to be taxed, but you can use them for non-medical expenses. And then high deductible health plan is $1,400 for an individual, $2,800 for family. Okay, so those numbers are not going to be tested because they do change each year. The 65 could, but I don't think you need to memorize what the amount for a high deductible health plan, because the questions are they can be used over multiple years. So it'll just be identified as a high deductible health plan if you've got that in a question. All right. More vocabulary. So here we go. Health maintenance organization, or typically just called an HMO. So what is an HMO? I just want to check the chat, make sure. Okay. Oh, some additional information here. So maximum out of pocket for HSA $70.50 and $14,100 for a family for HSA eligible plans. There you go. Okay. So that's the maximum out of pocket that you can have on those. HMOs. So what is an HMO? This is a single organization providing healthcare coverage or insurance. Now, when my dad had at one point an HMO available through his work, and that's what we utilized. And they're not as popular now as they used to be. I think somebody could correct me if I'm wrong there, but you don't hear about HMOs as often as you used to. But basically everything was provided through this single organization. So your health insurance was through them. Your health coverage was through them. You had to go to a doctor that was part of the HMO. You might be referred to a specialist outside of the HMO, but you always started within the HMO. So that's the first type that we're going to take a look at. So next, yeah, Kaiser is an example of that. So Jesse put that in there. I've used an HMO, Kaiser, and loved it, but I've also heard horror stories about other HMOs. I have too. So a lot of people do use Kaiser as their HMO. So that is a big one that's out there still. Okay, PPO, or preferred provider organization. This is a group of health providers, and they contract with health insurance companies to provide services. All right, so they are going to work with the insurance company, and they say, these are the services that we'll provide through this PPO. So again, you start with the PPO, you go to your doctor within that, your health provider. So they're going to, for example, my work, they list like, these are the providers that are in network. So if you're going to go see a doctor, you need to go to one of these in network, and then they can refer you out of network if they need to, but it's just a group of health providers, and they're all contracting with the health insurance company. All right, so generally it seems Kaiser is good except for mental health. Okay, here we go. So what is COBRA? Go ahead and go to the chat here and tell us what COBRA is. Expensive. Yes, that's very true. And why is it expensive? Paid by you when not working. Okay. You get it after you cut ties with your employer. Exactly. Yeah. So the idea behind COBRA, you pay your employer's part. Excellent. Yep. Let me read these additional comments here. Insurance that covers you in between jobs or after stopping work, because you have to pay both your portion and your employer's portion. You have to pay 102% of the cost. Help with insurance between jobs. Exactly. So the idea behind COBRA is that it allows former employees to keep your insurance. So for up to 18 months after you leave an employer. So everyone is correct that you have to pay the employee and the employer's costs. So I'll just give you a quick example. My high deductible health plan through my work is 100% covered by my employer. If I were to leave, I would have to pay the COBRA cost. I would have to pay the entire amount of theirs, plus they can do an additional 2% for the administrative tasks and things like that. So if they're paying, I don't know, let's just use easy numbers. If it's $10,000 a month, I'm going to have to pay 10,000 plus 2% on top of that. So Sonia says, is it better than Medicaid? Is it better to use Medicaid in that case? So it depends on if you qualify for it. I mean, Medicaid is one of those things you have to qualify for. So it kind of depends. I mean, it depends. And yeah, Medicaid has asset limits, all that type of stuff. And we'll talk more about Medicaid and Medicare at some point in this webinar today. Well, here we go. We'll go right into it. I didn't realize it was next. So true or false, you can have both Medicaid and Medicare at the same time. Is that true or false? Christina says true. So does Shannon. Kylie says false. Anyone else? Jessica says true. So does Nicole. Christina says if low income with Medicare, you can get assistance from Medicaid. Okay, Sonia says true. All right, so the answer is true. Yes, so just like Christina said, if you are low income with Medicare, you can also get assistance from Medicaid. So it is possible you can have both Medicaid and Medicare at the same time. They're two totally different things, both through the government, but they are, just because they sound similar, they are actually very different programs. And here we go, Medicaid and Medicare. So what is Medicaid? So Medicaid is regulated at the state level. Okay, so there are some federal guidelines in place, but they are regulated at the state level. And the idea is that it will help with insurance costs for low income individuals, low income families, et cetera, can utilize Medicaid. So they usually have a small premium or no premium, and then again, a small deductible or no deductible. So the idea behind Medicaid is it's there for low income individuals to utilize if they're struggling financially, they can still get the health insurance, or it's not insurance, it's a little different from that, but you've got coverage through Medicaid. So that's what that's there for. And then Medicare, this is a federal program, so it's done through the federal government, not at the state level like Medicaid is. And Medicare is for retired or disabled individuals. So it's for those two groups there, retired individuals and disabled. So with Medicare, there are premiums, there's deductibles, there's co-pays, there's co-insurance, all of that type of thing still holds true. So just like your insurance that you have right now, that you have through your employer, all of those things are there. And somebody pointed out that the premiums keep going up, just like they do in the traditional healthcare market. Premiums continue to go up every single year. They can be supplemented by secondary insurance. So example, Medicare Part D is the prescription drug portion, and that is, you can choose to use that or not. So you don't have to get that, but it is there. You can pay additional and get Medicare Part D if you want to. Somebody pointed out aid for the poor versus care for the old. Yep, Medicaid aid, so aid for the poor, and then Medicare, you're caring for the older individuals. So that's how you can keep a difference there. Thank you for sharing that. Summer says they're automatically removed from Social Security payments. That is correct. Yes, so your Medicare premiums are automatically removed from your Social Security payments that are paid out. And yes, there are a lot of letters in Medicare. There's Part A, Part B, there's the donut hole, all these different things, all these different terms that have to do with Medicare. Let's see, Medicaid also for disabled without enough quarters for Medicare. Exactly. Yes. Thank you, Christina, for sharing that. Okay. True or false? Short-term health plans can deny coverage for pre-existing conditions. Is that true or is it false? So short-term health plans can deny coverage for pre-existing conditions. Jackie says true. So does Sonia. And Jessa, sorry. Let's see, if you do not sign up for Part B on time, there are penalties. Yeah, so that's Medicare Part B. So yep, Nicole says true for this as well. So why is it true? Short-term health plan, so it just covers something for a short period of time. So it might be, you don't see these very often. Summer, please.
Yeah, can I jump in? Thank you.
Yeah.
So short-term health plans are a relative, I think they've been around for a while, but they're somewhat getting attention because they're vastly cheaper than insurance. Most states, you're only allowed to have them for 90 days. But if you have nothing, then 90 days is better than nothing. And some states allow them up to 364 days, depending on the state. Oh. But if it was 365, it would have to actually cover everything that's required under the Affordable Care Act to be insurance. So these are things that are sold as alternatives to insurance. But they don't have to follow all the rules of the Affordable Care Act. And so one of the parts of that is they do not actually cover pre-existing conditions.
Yep. Because otherwise, just wait, right, until something happens, and then
Yep.
go ahead and just get a short-term healthcare plan. So that's one of the reasons. So yeah, if I've got some issue, some medical issue, and Jackie says sometimes it's cheaper to have the short-term plan than to pay for Cobra, right? And that's why people might have it while they're waiting to get, maybe they've got a 3-month waiting period after they start with their new employer before health insurance kicks in or something like that. Yeah, so the answer to this one is definitely true. All right, true or false? Go back to the chat here. Renter's insurance is usually cheaper than homeowner's insurance. Is that a true statement or false? Jesse says true. Lots of things popping in here. Lots of trues. Good. Much cheaper, Christina says, can deny in health insurance for pre-existing conditions. Okay, yeah, so traditional health insurance, they have to cover pre-existing conditions. That's one of the things about regular health insurance. So it's just the short term that they can deny that. Okay, renter's insurance, going back to that, everyone's saying true so far. Good job. Yep, that is definitely true. It's usually quite a bit cheaper. So renter's insurance, and I think we talked about this. What was it, the first week or second week? I can't remember, but we talked about how rent, or maybe it was at school. I'm getting my dates mixed up here. So, but the idea is that renter's insurance, you're only covering your belongings. You're not covering the structure. That's got to be covered by your landlord. So they're going to have homeowners insurance that's going to cover it, but it's not going to cover your belongings. And with the homeowner's insurance, you're covering both the structure and your belongings. So that's why it's a lot more expensive. Summer says last week 1 or week 2. There we go. So time keeps flying. That's so true. All right. So let's take a look at what renter's insurance is then. I mean, I just told you, but basically the idea is it's a form of insurance that is going to protect the contents of a dwelling or a vehicle. So that's what renter's insurance is. It simply covers the contents. Renter's insurance may not cover flood damages. That is correct. You do need to make sure, if you're working with a client or you have your own renter's insurance, that you understand exactly what's covered, how much is covered, what are there any conditions, like it says that flood damage is not going to be covered, and what do they define as a flood? If a pipe bursts, is that a flood? So there's different things. So you do need to make sure that you read carefully the policy and you understand exactly what's covered. And that's why having a good insurance agent in your corner is a good idea, so that they can help understand exactly what you've got there. All right, homeowners insurance, moving on with vocabulary. So this is insurance that combines both the property and liability insurance. So it's going to cover the structure. It's also going to cover liability, which we'll talk more about. It's going to cover the contents. Everything is covered under that homeowner's insurance policy. Again, you need to understand exactly what it covers and what are the exclusions. So for example, earthquakes are not covered under any insurance plans that I know. So we buy a separate earthquake policy. We're here in Utah. They always talk about how eventually we're going to have a big earthquake here because we're right on a fault line. And so we felt like it was worth the money to purchase that separate insurance, but it's not covered. And a lot of people don't know that. They assume that, for example, if an earthquake hits, that it's going to be covered. Floods are never covered. A traditional flood, you have to buy flood insurance instead of having it covered through your homeowner's insurance. So it's important to understand what it covers and what it doesn't cover. And as an AFC, that is something you can definitely help your clients understand is what's covered and what is not covered by their insurance. True or false? Homeowners insurance is required by law. Is that true or false? Let's see, we've got true, false, true for a mortgage, yes. False, false, true in, is that Massachusetts, Maine? I can't remember. So true in some states, okay. Let's see, we've got a false. So we've got a good mix here of true and false. So Massachusetts, that's right. Okay, so it is false. No, so it could be required by the state, but as far as federal government goes, it is not required. So for example, let's say you pay off your home and you've got, I don't know, $20 million in the bank and you're living in a $400,000 home. You may choose not to have a homeowner's insurance, that you can cover that yourself if you need to. So your mortgage is definitely going to require it. So whatever the mortgage company is, they are going to require you to have homeowners, because again, there's loss on the line there for them, that if your home burns down and you don't have health insurance, then it's, or not health insurance, sorry, homeowners insurance, that they're going to be out quite a bit of money there. So yeah, it is tricky. So Nicole, thank you. It sure is. All right, vocabulary, moving on, property insurance now. So property insurance, this is insurance that covers the cost of repairs or replacement of property. Okay, so anytime that let's say that your roof is damaged in a hailstorm. We had this happen when we lived in Missouri. The cost of that repair or replacement of the roof was covered by our insurance. So it could be repairs, or in that instance, it was damaged so badly from the hailstorm that they just, they tore all the old shingles off and put new ones on. So it covered replacement of that. Liability insurance. So this provides financial protection when you are legally liable for somebody else's loss. So basically, if you're going to get sued or something like that, your liability insurance is in place to provide that financial protection. So let's see, in the chat we have, is property insurance different from homeowners insurance? No, property insurance is part of that, but property can also be on your car. So it kind of crosses over there. So it's not different from homeowners insurance, but it covers the property portion of it and not your belongings specifically. Can you add property? Can you add property to a policy, or it's a component of most insurance? That's right. Nicole, I'm not quite sure what you mean by can you add property. So homeowners insurance is one type of properties insurance. Yep. Homeowners, renters, and autos are all property insurance. Insurance and have homeowners insurance. So homeowners insurance is insurance. So maybe you mean property insurance. So homeowners is a type of property insurance. So again, like Summer said, homeowners, renters, and auto they all have property insurance as part of it. All right, moving on here. So let's take a look at homeowners insurance. There's three different things we want to look at here: considerations, property component, and then the liability component. So considerations, all peril versus named peril. So this is taking us back to the very first of the webinar here, peril and what that is. So that's the event, remember, that actually causes the loss. So in some homeowners insurance, it covers all perils. So no matter what happens, it's going to cover those. Versus named peril. So named peril is only the specific things that are named. So if they say we cover hail and tornado or whatever, they can name what they are and it covers those. But if the damage is caused outside of those named perils, then it's not going to be covered. Most insurance is all peril. A good insurance agent is going to always recommend all peril versus just named peril, because you never know, right, what's going to cause that. So considerations, actual cash value versus replacement cost. So these are two very different things. My car is worth, or let's go with a TV, because this was the first example that I remember from my insurance class. So we talked about how when you get a new TV, as soon as you use it and it starts to get, a little bit older, it's not worth a whole lot of money, right? It might be, you might have a $2,000 TV that is now worth $400. So if you're getting actual cash value insurance, it is going to pay you $400 if that TV is stolen. Versus replacement cost, they're going to pay whatever the replacement would be. So if the replacement is now $2,500, they're going to cover that. So that's the difference between actual cash value and what they're going to cover there versus replacement cost and how much they're going to cover there. Okay. All right. Moving on to the property component. So the structure is simply the structure, that it's the stone on the outside, it's the brick, it's the roof. Everything that makes up the structure of the building is covered under that property component. Personal property is just all your stuff inside, right? Your TVs, your chairs, your table, all the stuff that's inside is covered under the personal property portion. And that's what the renter's insurance covers, is the personal property, not the structure. So that's the difference there again. You can also have riders, or they are required actually, for certain expensive items. So if you've got expensive jewelry, an expensive piece of art or something like that, it has to be covered under a separate rider. So they're going to appraise that item, and they're going to say, okay, if this painting is stolen, it's worth $750,000 or something like that. It's not going to be covered under the regular homeowners insurance policy, So if you do have expensive items, say a jewelry item that's been passed down through generations, then you want to make sure that you get a rider for that. Liability component of homeowners insurance. So this covers your personal liability outside of work and use of vehicle. Okay, so I think we look more at liability here in just a minute, but also covers when someone is injured while on your property. So I'll just share a family example here. So my sister-in-law was at a friend's house and at a party, and they were swinging on their porch swing, and the swing actually broke and landed on her leg while there were like 3 people on it. So broke her leg in like a couple of different places. She was in a cast for a long time. The liability insurance covered the portion. It helped pay, they had the medical insurance in place that helped pay for the broken leg, but they actually paid a portion. They were also given just some additional money for the pain and suffering that was caused by that accident. So that, she was injured while it was on their property. So their homeowner's insurance paid that. Okay, so a couple of things in the chat. Renters and homeowners should get an inventory or video of the property. Yes, such an important thing. Thank you for bringing that up. And that's something that you can talk to your clients about, is you should walk around and just certainly get pictures of the most expensive things, but using a video and just walking through each room and saying, okay, I'm in the office now. Here's our computer. Here's the various things that we have in our office that are all covered. So it's important, yeah, that you've got that video. Let's see. Shannon says, is it like car insurance where your rates skyrocket after use? That's a good question. So I'm trying to think. When we were in Missouri, we made that claim on our roof and we didn't see any initial increase in the cost. I'm trying to remember if there was any additional increase in the cost of insurance. Somebody might be able to share an example in the chat here. If you've utilized your homeowner's insurance, did you see the rate go up as a result of that? So, and we'll go ahead and read Summers while some people might be commenting in here. So I recently got renter's insurance and they didn't ask for an inventory. I actually asked them if it was needed, but it's definitely required for homeowners. So it is required in a lot of cases, but I've never actually been asked for it. So it might say in the documents that they require that inventory, but beyond just saying it's required, I've never actually been asked for it. We've got it, we've got that inventory, but not required for homeowners. Good idea though. As a result of what, adding art? No. So the question is, let's say that your roof is damaged, or somebody breaks into your house and steals all your computers and TVs and stuff like that. Do you see an increase in the premium as a result of that? That's what the question is there.
I'm just going to quickly jump in and say, I'm going to guess it's not as likely. Auto insurance, if there's an accident, even if you're not at fault, there's often the possibility that you were sort of at fault, while homeowners insurance, very few of those claims are going to be because of something you did wrong. And I bet if you did something wrong, that might impact it, but you can't control a hailstorm. On the other hand, if there's a hailstorm, everybody uses the insurance. It probably goes up because they just paid out a ton of insurance.
Yeah. Kylie says we had to replace our roof and did not see our rates go up. Okay. So yeah, in a lot of cases, I think you're right. And we didn't see that either when we had to replace our roof. All right, moving on with additional vocabulary. Christina says, I actually had a question about art and insurance, maybe for the end. Okay, sure. We can certainly answer it then. If you have a loss and you're not covered, you may need to deduct the total loss for taxes or making a claim with FEMA and SBA. Yeah, thank you for sharing that. Okay, what is umbrella liability insurance? So this is catastrophic liability insurance. So it covers losses above the amount covered by your other insurance. Okay, so with your homeowner's insurance and your auto insurance, you've got liability coverage that's going to cover you if you're sued or something like that. The idea behind umbrella liability insurance is that both of those max out. Your auto insurance and your homeowners, they max out at sometimes a fairly low amount. So an umbrella liability insurance policy, they're fairly cheap. I hesitate to use that word because they might be cheap for one person, but that amount might seem very different to somebody else. But the idea is that they cover a larger amount. So you buy liability insurance in $1 million increments. So you can buy a $1 million liability insurance, $2 million, $3 million, whatever. You're going to have to prove that you need that much. But anyone can get $1 million liability insurance policy. They'll make you go to the maximum liability on both your auto and your homeowners before you can buy it. But once you've maxed out what you can get there, your liability insurance then kicks in, because you might be sued for, let's say that the max on your auto insurance is $300,000, but you're sued for $1 million. The liability, your umbrella liability policy would kick in at that point. Summer says umbrella policies do require you have a set amount of underlying insurance. Exactly. Do you recommend umbrella liability insurance? Yes, absolutely. It is something I definitely recommend that everybody has. So what scenarios might they be a good idea? Owning a home or driving a vehicle. Those are two examples of times, scenarios when it's a very good idea to buy these. And both the CFP and the AFC like umbrella liability insurance policies. In fact, I seem to remember reading something that said on the CFP, it said the answer is always umbrella liability insurance. Like if you're looking at additional insurance to buy, that you always get that. So always a good idea. I asked about it when I was upping my renter's insurance. It required that I triple my auto insurance limits, and my limits were pretty high for Montana. Yeah, something to take a look at there. All right, so moving on. Comprehensive auto insurance is required by law. Is that true or false? Go ahead and pop that in the chat. We have lots of falses coming in. Yep, everyone's saying false. Good job. So it is definitely false. And we'll look at what the various parts of auto insurance here, what they are on this next slide here. All right, so what are the different types of auto liability insurance? So bodily injury and property. Those are the two different parts that we're going to be looking at here. That's the liability portion. So it's bodily injury and property. I know, again, there's a lot of vocabulary with insurance. There's a lot of different moving parts that you need to understand. So flashcards work very well for this section. So liability, auto liability, you've got bodily injury and property that are covered. So what does collision insurance cover then? And I'm going to, yes, +1 for flashcards. Financial trivia. So what does collision insurance cover? Does anyone know? I'm going to give you a second to put that in the chat. Body of the car, okay. Others? The car itself, okay. Actual crash / body of the car, okay. Damage to the vehicle, yeah. So it's impact with a car or other object, okay. So that's what collision insurance covers, is that impact. So let's look at the various parts now. Oh, I guess I'm just gonna put the answer to this up here. So comprehensive insurance, and then we'll go through all the parts together. So Shannon says what you destroy. Yeah, everything other than liability and collision, property only. So let's go through. Oh, I thought we had a slide about this. Summer, that might be helpful to do a summary slide of all the various parts of auto insurance. I thought it was in here. I thought I saw it the other day, but that may be something that we want to add to this. So let's go back though and make sure that we cover what all of these are. Okay, so we've got comprehensive. First of all, comprehensive auto insurance is not required by law. Typically, you're going to have to purchase insurance through your state is going to your state requires insurance on the car, right? They require you to have that liability portion, but not the comprehensive portion. So yeah, so Summer says she'll add that slide to this. Okay, so then we've got under the liability portion of auto insurance, we've got that bodily injury and property. Okay, so when you're looking at your insurance, your auto insurance rates or your coverage, it always says something like, I'll just put numbers out there. So like 100, 300, 100, or 10, 50, 20, or something like that. So the first number in that's what liability insurance is. So the first number is bodily injury per person. So my insurance, I'm pretty sure it's 100, 300, 300. I think that's what we've got on our insurance. So per person, we've got $100,000 worth of liability insurance per person for bodily injury that would cover any injuries. The second number is per accident. So that 300, I think it's, like I said, 100, 300, 300, that 300 would cover per accident total. So how much bodily injury are they going to pay out total? And then property is that third number on there. So we've got $300,000 worth of property liability insurance on there that would cover the property damage to other vehicles, that would cover if it hits a house, if our vehicle hits a house, if it knocks over a mailbox, whatever, that would be covered through that property liability portion, that third number in the slide, or in that those three numbers that you have with auto insurance. And then collision is any sort of impact with a car or other object. So that's what collision insurance covers. It covers your vehicle. Instead, the first one is covered, the liability covers the other person's vehicle, but collision covers your vehicle. And then comprehensive does the same thing, but it's everything other than liability and collision. So it's property only to your car. It's not medical, it is property only. All right, what insurance do you need to cover your medical bills in an accident? So this is personal injury protection. So that's the type of medical, when you're in an accident, you need that personal injury protection to cover that. True or false, if you have liability insurance and are hit by someone without insurance, your insurance will cover your loss. Let me read that again, true or false. If you have liability insurance, you're hit by somebody without insurance, your insurance is going to cover that loss. Is that true or false? Shannon says false. So does everybody else. Good job. That is false. Okay, your new car is stolen. Will comprehensive insurance be sufficient to pay off your loan balance? So what do you think? It's not true or false. This is just, share your thoughts here. Your new car is stolen. Will comprehensive insurance be sufficient to pay off your loan balance? Gap insurance. Yep, exactly. Depends. Some people are saying false. So yeah, exactly. In most cases, it may not be with a brand new vehicle. So that's what gap insurance is for. So gap insurance, it says in the event of a loss, it covers part of the cost of a vehicle with a high loan to value ratio. So yeah, so some other people are saying you need gap insurance on the loan. So if you've got a high loan to value ratio, your whoever you're getting your insurance through, say, or whoever you're buying that vehicle through, they may require gap insurance on that. So they'll often try to sell it to you on a new one. You don't always need it, but it is there to cover that additional amount if you have a high loan to value ratio. In fact, in a lot of cases, they may require you to get that gap insurance. Okay, true or false? The lowest deductible is always the best deductible. What do you think? False, 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 false. Yep, everyone's saying false so far. And I would agree with you. It is definitely something that is always false. So lowest deductible is not always the best deductible. In some cases, having a higher deductible is definitely a good idea. Okay, real world finances. How might life changes impact your need for life insurance? So what are some examples? So looking at life insurance now, what are some examples of when you might need to either get life insurance or increase the amount of insurance that you have? Yeah, kids is a big one. Illness, yep, could be another one. Having a child, children, yep, exactly. Marriage, child, home, good. Small business, having kids, leaving the workforce, one spouse, okay. Illness, expanding your family, birth, death, marriage, divorce, good. Children growing up. Yeah, that can change it as well. You might not, and not needing the support, exactly. You might be able to change some things at that point. Leaving a legacy, yep, that could be an example as well. So good. So we're moving on to life insurance now. So let's talk about the vocabulary behind life insurance. So policyholder. This is the person who actually owns the policy, also called the policy owner sometimes. So they pay for the policy and they also designate the beneficiary of that life insurance policy. So they own that policy. There has to be an insurable interest when you first get it, but the policy owner, the policy holder is the one who pays for it ultimately. Okay, the insured person is the person whose life is insured. So for example, let's say that I've got a lot of life insurance on me. We've got a lot on my wife as well, but so I'm the insured person on that life insurance policy that covers me. So it's my life that's insured on that. The beneficiary on life insurance is the person who receives the death benefit. So on my insurance, for example, my life insurance, my wife is my primary beneficiary. My kids are my secondary beneficiary. So the beneficiary is simply who the money is going to go to once you pass away. So again, you've got a primary beneficiary And you should make sure that there's a secondary beneficiary on there as well. Otherwise, the money is just going to go to the estate. So that's something you can do as an AFC and as a financial counselor, is you can help people understand who the beneficiaries are and make sure those are kept up to date. And that's important in a divorce, that you make sure that, especially if there's a remarriage, if you want to make sure that a policy would cover your new spouse, that's something important. Now, you may have to cover the old spouse as well, or the previous spouse through because of the divorce decree, but you want to make sure that all of that is up to date. Okay, so life insurance, there's two major types of life insurance. There's additional subtypes as well, but these are the two types that you need to know. So term life is simply a death benefit. And so it covers you for a term of period. So it could be an annual renewable policy. So it could just be a 1-year term. It could be 5 years, 10 years, 15, 20 years, whatever the case is. So you've got this term insurance that covers a certain period of time. Sometimes it's up to a certain age. So there's lots of different terms that can be included in that. And what happens is the older you get, the more that the price goes up of that term life insurance. So let's just say you may have a 10-year level term policy. So for all 10 years that you have that term insurance policy, the premium's going to be the same. So when I was first working, I had a small policy through Beneficial Life. It was a life insurance company that no longer does insurance, but I remember the premium for some reason, it was $10.41 a month. And that was every single month, it was that exact same amount. Now, after the 10 years was up, it went up quite a bit. I was surprised at how much it went up after the 10 years. And so we switched it out for a different policy. But that's the idea, is it covers that period of time. So if you don't renew that policy, or it doesn't convert over to a 1-year term policy, then once that insurance is up and it's over, there is no death benefit associated with that. So some people associate it with renting, like you're saying, like, I'm renting this insurance for a period of time. So, a time when we get additional term insurance when our kids are young and when they're growing up, and we may have to cover some college costs to pay off a home, something like that. A lot of those things are often covered through term insurance. Whole life is different from term insurance. It's still got a death benefit attached to it, but there's also something called the cash value attached to it. And so it's got the death benefit, but it's also got an investment or cash benefit as part of that. So it's tied in. So part of your premium goes towards the death benefit. Part of it goes towards building up that cash value. So price starts higher, but it's going to stay the same. It's also permanent insurance. That's why it's called whole life or permanent insurance, because it is there for your whole life. So as long as you're paying the premium, it is going to be there. And we'll talk more about cash value here in just a moment. But I want to go to the comments here. Multiple year term policy will convert over to annual renewal policy with premiums increase every anniversary date. That is right. So if you've got a 10-year insurance policy, level insurance, it'll go to an annual renewable policy after that, but the premium is going to go up every year. Cash value, what they will give you if you sell the insurance policy back to them. Yep, you can borrow against this amount, but you can't actually cash it out. That's right. You can cash it out, but you're canceling the insurance policy. So there's going to be a cash out amount, but you can't just take money on it. You can take a policy loan, like she said, but then you pay that back to them. So. All right, so trivia. Who gets the cash portion of whole life insurance when the insured dies? Who gets that? Go ahead and go to the comments here. Beneficiary, okay. Anyone else? The insurance company, okay. Depends upon the policy type, true, yeah. Okay, in a typical cash value life insurance policy, the cash value gets absorbed back into the insurance company. So there are different types of insurance. So you may have some that pay both the cash value and the death benefit. But yeah, the cash value does go back to the insurance company. So the cash value is meant to be a living benefit. And I don't want to get too deep into this because we've got some additional things to cover here. But the idea is that the cash value is meant to be a living benefit. So you can utilize it to purchase a property. It can be used as an emergency fund. There's all these different things that are there as the cash value, and there's lots of things that we could discuss. And if you ever get deeper into insurance, there's all these additional riders that you can add to cash value insurance. So there's lots of different things out there. But in a typical life insurance policy, it does get it absorbed back into the insurance company, and then they still pay the death benefit. So that is still paid out there. So somebody says type A cash value builds up under the death benefit. Exactly. There's different types out there, but typically what happens is that cash value does go back to them. Again, there are policies or riders that you can add where the cash value will build up over time. So type B cash value builds up above the death benefit. Yep. All right. Other insurance. So there are 3 different things that we want to take a look at here, other types of insurance. So short-term disability insurance, long-term disability insurance, and then long-term care insurance. So short-term disability insurance is going to cover your wages or a portion of your wages, not all of them. It's going to be a portion of your wages if you're temporarily disabled. Okay, so long-term disability always has a waiting period with it. And so some people will get short-term disability to cover, let's say it's 3 months before your long-term disability kicks in. That short-term disability insurance policy will cover that 3 months until your long-term disability kicks in. It does have a waiting period. It's shorter, where you can't utilize that short-term disability insurance. That's what your emergency fund is for, is to help cover that short-term disability or short-term emergency. And sometimes it's provided by the employer. Not always. They're certainly not required, but it is an option. Some employers provide it, others don't. Long-term disability insurance. So this just simply extends that short-term disability coverage, or in some cases there is no short-term. But the long-term is in place, usually through age 65 is when long-term disability is in place. It does have a longer waiting period, so it might be 3 months before that long-term disability insurance policy kicks in. Usually not paid for by the employer, but sometimes. So mine through UVU, they choose to pay for our long-term disability. When I was at the University of Missouri, I think it was a split. Like we paid part, they paid part. So lots of different options there with that long-term disability. So sometimes paid by the employer, sometimes it's not. And then long-term care insurance. So this is custodial care that is not covered by Medicare. So this is different from Medicare. It's custodial care that is not covered by them. So long-term care insurance can cover a portion of those costs, and it has what are called activities of daily living requirements. So you've got to be able to, your long-term care insurance policy might say you can't do 2 of these activities of daily living, which I don't know if you need to know the activities of daily living. There's some acronym for them. Somebody might know what that acronym is. I don't know if you need. Yeah, go ahead.
It's hard for me to believe that you would actually need to know them.
Agreed.
I assume most financial counselors probably aren't going to, and that's the sort of thing that's why they do a job analysis survey.
Exactly. Yeah. But it's things like dressing or getting to the toilet by yourself. There's all these different activities of daily living. All right, financial trivia. So what are the steps of risk management? You've got a client coming in, and this meeting is all about risk. What are some things that you're going to talk about with them? What are the steps that you're going to make sure that you cover in that appointment with that person where you're now talking about risk? What are you going to cover? So this appointment is all about risk and insurance. What are some things that you're going to make sure you talk about? Oh, those are some of the activities of daily living. So ambulation, transfer, toileting, feeding, etc. Okay, Angela says identify the risks. Absolutely. Yeah, what else? What else are you going to cover in this appointment? What insurance do they have now? Excellent. Yes, thank you, Shannon. What else? What their needs are. Thank you, Nicole. Absolutely. Yeah. How much coverage is needed? Thank you. What insurance they might have through their employer? Good. Any upcoming life changes? Good. What are their lifestyle hobbies? Yeah, if they like to skydive, they're going to pay more for life insurance. Estimate the risk and potential loss. Yep. Thank you, Gabby. What else are you going to cover? What about AD&D policies? Is that just paid as an employment benefit paid by the employer? So AD&D are accidental death and disability policies. These are not always paid. They're not always an employment benefit. So I know, for example, I'll utilize myself as the example here. We can get additional accidental death and dismemberment policies. Dismemberment is you lose a limb or a finger or something like that, and so we can add those. But they are additional cost, and my employer doesn't actually pay for that. So you can add it, and it will pay additional if there is if the death is caused by an accident or if there's that dismemberment. But it's sometimes paid by the employer, sometimes it's not. Sonia says frequency and amount. Isn't ADD paid out only if the death certificate says accident? That is correct. Yes, it does have to say accident for that additional amount to be paid out. Alternative to risks that are present. Yes, excellent. Thank you, Shannon. Finding out what their risk tolerance is. Very good. Yes, there's lots of quizzes out there you can utilize for risk tolerance. Anything else that you would cover? Excellent answers so far, by the way. You're all ready for an insurance appointment. So okay, let's go through here. So yeah, plan how you would handle the risk. Very good. Thank you, Gabby. So here are the steps. There's 5 steps to risk management. So number 1, you always want to identify what the risks are. Okay, so what are the hazards? What are the perils? What are the exposures that they have? Those are all things that you want to take a look at with them. Determine the amount and frequency of the potential loss. So how often does it happen, and what would how much would it cost if it did happen? So if your home burns down, how much is it going to cost? If your car is hit by, I don't know, you run into a tree or something, how much is that going to cost you to replace that car? Choose how to handle it. Yeah, are you going to retain it? Are you going to transfer it? Are you going to try to reduce the risk of loss? So all of those things are things to take a look at. Implement the risk management plan, which is going to typically include insurance. So that would be part of a person's risk management plan. And then you evaluate and adjust as you go. And especially as life changes happen. A few people mentioned life changes. You add a child to the family, or there's a death or a divorce or something like that. All of those are times when you evaluate your insurance. Now, something else that I do is every year in January, I send an email to my insurance guy. He does our homeowners and our earthquake insurance is through him. And then our auto insurance is through him as well. And I just say, hey, Jacob, it's January, time to do a review. And I just say, here's anything that might have changed or additional things from this past year. Can you do a review of our insurance? And so we just barely completed that. We added the earthquake insurance this year that we haven't had in the past. We've got a daughter turning 16 this year, a second daughter. So we know our insurance is going to be going up. So he'll be taking a look at that with us. And then just every year we're evaluating and seeing, okay, what is it that how can we save money this year? Are our deductibles all at the proper amount? How much would we save if we increase this deductible? All of that we just do automatically in January. You could do that with your clients as part of a meeting each year. And that brings us to the end. Shannon says, I'm not old enough to have a 16-year-old. I've got a daughter turning 18 this month. Yeah, it's kind of crazy. I can't believe we've got a daughter turning 18. And then my other kids are 14. I've got a 9-year-old and I've got a 5-year-old. So but thank you, Shannon. You totally made my night there. So we have 15 minutes, which is time now that we can discuss things. So I'm going to stop sharing here. I'm going to go over to my regular screen here. And this is a time for you to ask any questions that you want about insurance, or it could also be something else. So let's see, just to clarify, if I've got a 30-year term insurance, my premium stays the same for the 30 years. Yes. If you've got a 30-year level term insurance policy, it is going to stay level that entire 30 years. So it's not going to increase after year 10 or anything like that. It will stay the same all 30 years. And I see that often. So when somebody has a child or something, they'll get like a 25-year or a 30-year level term insurance policy. It's going to be more expensive than a 10-year policy or a 5-year policy, because obviously your chances of dying over a term of 25 years is greater than over 5 years. But the idea is, okay, this term insurance is in place to cover, if I were to pass away, it would cover childcare, it would cover school, different things like that. Never understood taking out a life insurance policy on someone without their knowledge. You actually can't do that. So there's typically a medical exam that goes along with that. So when the person shows up to do the medical exam, they're probably going to figure out that something is going on. There also has to be an insurable interest when you first get it. So I can't take out a policy on my neighbor because there is no insurable interest there. Yeah, I care about my neighbor, but if they were to pass away, I'm not harmed financially. So there's no insurable risk there. There isn't a business, so you can definitely get insurance on like business partners or on key executives. Typically an insurance policy will be in place on a spouse, on children, but certainly not on a neighbor. So there has to be an insurable interest there. Shannon says even spouse, yeah, you can't get, if there's a medical exam required, then your spouse is going to know that it's there. So you can take it out without an exam on a spouse, but amount is typically lower. Yeah, that is correct. So I'm just trying to think through like my work insurance, for example. So I can add, like I've got a certain amount that covers like 3 or 5 times my wages, whatever it is. And then I can add additional insurance on my spouse and kids. And they know about it, but there's no medical exam tied to that. So I guess technically, but my wife certainly knows about it. So
I think generally speaking, the key is you can't really get life insurance without them knowing about it, because that is a reason why murdering them would be like,
right.
Financial incentive. So yes.
Yep. Okay. So Julie says you can't get life insurance for your children. You certainly can. Yeah, you can definitely get both term insurance. So I've got some very cheap term insurance through work. And then you can also get whole life policies on kids as well. So there's not, the idea behind life insurance is there going to be a financial loss? And so some people will get just like a small, say $10,000 to $15,000 or $20,000 policy on their kids that would cover funeral expenses and things like that. But that you're not relying on their income specifically. So that's why, sometimes you get a very small amount, but yeah, you can definitely get it on your kids.
If I can just say from personal experience, this is Kylie, my husband's job. He had the ability to add myself and our 2 children to life insurance, like to have separate life insurance on us. The amounts were lower, so we didn't require an exam. Right. All he had to do was put in our names and our social security number. So I guess technically he could have done it without letting me know, but right. We didn't need an exam for it.
Exactly. Yeah. Same with my policy that I have through work. It's that exact same way. So Shannon says never be worth more dead than alive. Yeah. Can you please give an example on how you can borrow against your whole life insurance for your business or any other expense? Yeah. Okay. So that's a good question. So a whole life insurance policy, again, it's got this cash value that's building up over time. So let's just say it, and it's slow, especially in the early years. But let's say I've had this cash value policy for 25 years. It's got a death benefit tied to it, but over time it's built up, let's say $50,000 worth of cash value. So the way that cash value life insurance works is I can borrow against that 50,000. So let's just say I want to buy a new car. And you might have heard this idea of like bank on yourself. There's all these books and websites out there that teach you how to do this. But the idea is that I say I need a new car. And instead of borrowing from the bank and paying them interest, I'm going to borrow that from my life insurance policy. So I can withdraw, say, $25,000 to pay for that car. And so it's not a withdrawal and it's a loan, it's a policy loan. And with whole life insurance, you actually are going to pay interest on that when you pay it back. But the idea that people say, they're like, well, you're paying interest back to yourself. And while that money is out, every whole life insurance policy that I've ever seen is still paying you interest on the full 50,000, not just on the 25,000 that's remaining in there, but on the full 50,000. And so the idea that they always say is that you can borrow against that, and you can then you just make payments to yourself every month, and you pay back that your whole life insurance policy. So yeah, you can use it to buy a car. You can borrow against it to go on a trip. You can borrow against it to pay for funeral expenses, whatever, for somebody, if you're covering those funeral costs, you can borrow your cash value insurance for anything. There's no credit check or anything like that. It is simply the cash value that's in there that they are determining. So that's an example there.
Can I just quick jump in? So life insurance is one of the things I actually really struggled with when I was getting my AFC. So it's one of the areas where I've done like additional extra study. And so one of the questions I always ask myself is, when is this applicable and when is it not? So for like term insurance, that's really applicable if you're young and, because it's cheap, then you don't have a high risk of dying when you're young, right? And then especially if you have kids or something. Whole life insurance is if you really need a death benefit, and how need is defined however you choose to define it. But one case where is especially applicable is often if you have someone who has a child with a disability, because they're basically having to come up with resources to cover 2 whole lifetimes. And so, but not everybody needs life insurance. I don't have life insurance. I'm single. I have no kids. There's enough assets in my account to pay for my funeral. So, just depends on the person.
Yeah, for sure. Okay, Sonia says, I'm volunteering with women with cancer and low resources. What options would you have? Because sometimes they can assess Medicaid or access Medicaid, but sometimes not. And they get bills for thousands of dollars. What would you recommend? So, I don't know right off the top of my head. I mean, there's might be, if Medicaid is not available, then, are there other resources available through the state? Are there, I would certainly check with, I just lost the name of the word, United Way, see if there's something that they could refer you over to something. But certainly, see if they qualify for Medicaid first, but then if not, then, check with your state resources. Others might have some additional recommendations. So we'll see if anyone else has things in the chat, or you can jump in as well. So loan balances are deducted from the death benefit upon death. Oh yeah, that's important to recognize. So on that insurance policy, so you don't have to pay the loan back, right? Okay, so if I take out, say, $20,000 out of my cash value and I don't ever pay that back, which you don't have to, you can choose not to pay that back. And my death benefit is, say, let's just say I borrowed 10,000 and I take out 100, or my death benefit's 100,000. If I haven't paid that back, they're going to deduct that 10,000 and my beneficiaries would get 90,000 instead. Okay, Kylie says to Sonia, they may need to contact the drug companies to ask to be added to any programs. And then for the doctors, you have to contact each and ask for some forgiveness. They have some money set aside for that purpose, but for both drug companies and doctors, it's first come, first serve. Yeah, so, okay, excellent. Thank you for sharing that. Call 211, which is United Way. So free info and referral services sponsored by United Way. Okay, and then I was on the Black Empower Financial webinar today, and the presenter said that minorities tend to have half the death benefit than white, thus reducing the potential for legacy. Yeah, that's interesting. Yeah, I've been reading a lot about that the last couple of days too, about the disparities between like the amount. I wasn't aware of the insurance one, so thank you for sharing that. But just simply, the amount of assets, the amount of debt, different things like that. It is vastly different for Black families. Latino families is also very different amounts there. So thank you for sharing that. It's important to understand that if you've got half the death benefit, it may not even cover your basic needs, for what your spouse needs after, if you were to pass away, your spouse and children. But yeah, certainly reduces that legacy. It's all a lot to understand, really, and life is already hard. It's hard to find the time to learn all that you need to know for each area. So true. It is, Kylie. And there's a lot. Insurance is one of the biggest ones here. And so I understand that it can be discouraging to hear all of this. And like, there's all these different life insurance policies, and there's different health insurance, and there's different portions of Medicare and Medicaid and stuff. That's why flashcards is really important for this section. Learn it, get to know it, and then, after the exam, you may not deal with it a lot except for your own, or you might work with clients on helping to understand it. But you can see why this is important for financial counselors to understand, because it can be very confusing. If it is for us as financial professionals, I can tell you that it is for your clients as well. So learning this well, it is going to serve you and your clients well. Drill, drill, drill. Yep, exactly, Shannon. Going through it over and over and over and making sure that you truly understand these terms and that you can talk about them is going to be important for you to be able to do.
And I'm just going to toss out there, yeah, study really hard for the test. And I really obviously think it's important for you to understand all of this. For exam purposes, do you remember that this is 8% of the test or something, or 10%? So yes, you should know it all, but please don't not test because of this one section. You will have time to practice this over time. And remember how much of this actually applies to you. So the other reason it was really helpful for me to learn things. All this stuff I learned is how I learned to go call my insurance company and say, hey, we need to discuss those limits in my car insurance. And, you know, oh, now I can read all the stuff on the Affordable Care, on like on healthcare.gov. I can read all those things now. I now know what out of pocket is. I know, you know, all those things. So applying it to you can be really helpful.
Absolutely. Yeah, it is important to remember that I don't have the numbers in front of me, but you know, things like goal setting and debt management and credit and stuff are a much bigger portion of the exam. So it is important to understand this, but don't over study this portion. I mean, make sure you know it, but don't, you know, you don't have to push.
And if you haven't looked recently, just go to afsp.org, click on certifications, AFC accredited financial counselor, and then right here are the core competencies, including the percentage of how much they are on the test and details. So managing financial risks is 9%. So I was 9%. On both sides of that. But you can look here and you can see a lot of the detail of what will actually be covered. Okay. Definitely check that out if you have not done so recently.
Yep. Okay, Valerie says after the exam, on the job experience will help. Yeah, will help the info stay in your mind. That's so true. And so thank you for sharing that, Valerie. As you're working with clients and you're like, okay, I know this person's coming in to talk about life insurance. You're going to review what you know about life insurance. You're going to have some resources there available. So it will help stick in your mind once you start working with this on a regular basis. So yeah, thank you for sharing that. Okay, we have about 3 minutes. We can certainly let you go early because most nights I go over. But we've got about 3 minutes left. If anyone has additional questions, comments, you can throw it in the chat or go ahead and unmute yourself.
So I had a question about the art and insurance.
Oh, yes.
So it's a personal question. I inherited art. My grandmother is an artist. After she passed away, I inherited some pieces that she decided not to give to museums.
Okay.
So for that kind of thing, is that something that you would have like an extra insurance policy or like an addition to your regular insurance policy to cover that?
Yeah, so it depends on the value because it's
like $35,000.
Yeah, then definitely. Yes, you would definitely want to get a rider on that. So contact your insurance company. They'll do an appraisal. So they'll either send someone out or they'll have you take pictures of it or something to determine the value, or if it's already been appraised, you could certainly send that appraisal in. But yeah, they're not going to cover if there's a fire or something unless you've got that rider in place.
Okay. Yeah. When I started looking at how so much some of it was, I was a little bit like, I was like, wow, I've never had anything this expensive in the place that I live.
Yeah. Now we all want to see what that art is, Christina. So next week, use that as your profile picture. We'd love to see it. So, there we go. She's going to share it.
This is one piece.
Oh, wow.
Cool.
Yeah. So she has pieces in the White House and embassies all over the world.
While you're showing that, by the way, just really quickly, we had a question that I want to make sure we answer before we stop the recording. So while you're bringing it, we had a question about how to access the course after the switch from Canvas to the online learning system.
Yes.
And you'll want to do that. You can access it through either learn.afcp.org. That's learn, learn.afcp.org. Or you can go to your dashboard at my.afcp.org and click on the AFC study guide tile, and that'll get you to all of your courses.
I was having an issue with that too, just getting into the bright, whatever it is from Canva. It just wasn't going through. So
Canvas is gone. So
yeah, I couldn't Canvas was easy to get into. This other one is like not. So that would just be contacting the AFCPE people, right? If we can't get in at all.
Yeah, if you can't get in at all, but Canvas is gone, so you now need to access basically through your dashboard. It's all